Good evening, guys. Welcome to P2 Corporate Reporting with me, Martin Jones. This is the London School of Business and Finance, and I am here to present to you through the medium of Interactive, our online product. And as I say, my name is Martin Jones, and this is P2 Corporate Reporting, the ACCA paper P2. And here I am. I have a slide that's going to pop up over my shoulder, at least that's what I hope it'll do when I press this number 2 here. And there I go into the corner. Am I going into the corner? I hope so. I can only see blank screen over there, so I don't know if I'm coming through to you. Welcome. As you can see, as it says over my shoulder, these are the Global Live sessions. We've got 8 of them, and this is the first. There's my name and also my email, which I will be reinforcing right throughout the evening. We have 16 hours, 8 sessions. It's pretty intense, there's no messing around, so let's get into this. I'm just going to get that page to go down. Here we go. So we're doing basic groups tonight. The cornerstone of corporate reporting, the foundations of corporate reporting are based upon group accounting, and that's where we're going to start today with the basic questions within chapter 1. I have a chapter 1 over my shoulder about to pop up. Let's see if I can make that happen. So here we go. There we go. So there's the class notes. I'll just maximize those. They seem to have gone a bit diddy. Let's get them on. No, it's all right. It's all right as it is. So there we go. And we're going to flick all the way through to the first chapter, which is basic groups. And there it is. Sorry, just a bit too far there. So basic groups. Now, the product isn't working exactly how I was hoping it would be. There's supposed to be a screen just on my left-hand side that's showing a little mini-me and proving that I am coming through to you live. But the chat, which is just below that on the left-hand side, is actually chatting away. So in order to reinforce the feeling of togetherness, give me a hi, a hello, a hoopla, a come on. Give me some chat over there so that I know that we're interacting on Interactive. Yeah, good. Good stuff, guys. So you can see me. You can see me. Fantastic, 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 fantastic. Good stuff, guys. Now, I reckon that over my left shoulder, there's an expression, and I'm just going to be, really cautious about whether I'm coming through to you. I'm going to do a little bit of highlighting there. This highlighter's come out a bit naff. I'll sort that out in a second. But what have I highlighted in fairly naff yellow? Tell me what we are doing tonight. Tell me what I have highlighted over my left shoulder. Yeah, great. And Troy, you had a fantastic question earlier. For those of you guys who are watching this as a recorded, you won't have seen Troy's question. He was asking about the B section and how the examination is made up. There's a lot going on in P2, and before we're going to go into the detail of the examination, I basically want to teach you some stuff. I want to teach you basic groups is what I want to do. So I've got a middle session, session number 4 actually, where we're going to talk about how the exam is constructed, give you a feel for the breakdown between numbers and narrative and what you need to know and so on. So I have a whole session that is a whole middle section of a session, not a whole session, a whole middle section of a session that is dedicated to how the exam works, how the examiner thinks, how he writes questions, and how the exam is constructed. That's waiting for you in session number 4. But Troy's got a question now, and it's related to the B section. The A section is essentially 35 marks of numbers, and the B section is essentially 65 marks of narrative. And Troy has asked, do I need to know the IFRS in order to do the B section? And I might as well answer that question now, as it's a nice question. The answer is yes and no. You do not need to know any IFRS numbers. But what you do need to know is how to account for goodwill. What you do need to know is how to account for non-current assets. What you do need to know is how to manage financial instruments. And all of that I will teach you, starting now. With this fella here, a blank journal note. Off we go. So groups starts with 3 relationships. Groups, sorry about my writing. Writing looks a bit spaz there. This is a fairly odd pen running on an unusual program. It looks a bit like Windows Journal, doesn't it? But it's not actually. Groups, group accounting is based upon relationships, upon relationship concepts, of which there are 2. The first one is control. 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 Control is the power to direct activities and gives rise to a subsidiary that is consolidated using acquisition accounting. Goodness me, there's a lot of information in that one first sentence, isn't there? And I'm going to break down that one first sentence in just a second. But before I do so, I want to be upfront about the charter, the contract I have with you. The contract that I have with you, which I'm hoping will be reciprocated. So a charter, a contract that you have with me is this. Everything that you really need to know, I will write it down. But everything I write down, you really need to know. It's a contract I make every time I do this first presentation. Everything that you really need to know, I will write it down. But everything I write down, you really need to know. And therefore, your homework every weekend, the first components of your homework every weekend will be to make sure that you really understand what we have done together, over the previous 2 hours on the Thursday. So your homework every weekend is always the same. Make sure you're cool with what we've done first. Now, of course, you might not know this, but you probably do. P2 is effectively an infinite syllabus going off in all directions. And what I certainly won't attempt to do is to teach you everything in the dark corners. Because the truth of the matter is, the stuff in the dark corners almost certainly won't get examined. And even if it does, you probably wouldn't be able to do it even if you did know what was going on. It's, there are so many crazy dark corners. And the real centre point of this examination, the real body of this examination is in the centre, and it's with that you get yourself, you can get yourself 100% with the centre, if I'm honest, but it certainly gives you at least 90, and that would do, wouldn't it? You could make do with 90%. So that's what we're aiming for. By looking at 2 concepts, there's actually 2 relationships. Let's have a look at the other one. Oops, gone a bit far there. Influence. Influence is the power to participate. In management policy. and gives rise to an associate. That is, let's use the same language, that is rolled forward using equity accounting. Troy. Which IFRS is the IFRS on control? Who knows, who cares? But you do need to know what control is, and you will be writing this sentence. Troy. What's the IFRS on influence? Who knows, who cares? No marks for the IFRS number, but knowing what influence is and being able to write it down, that's what the mark is for. In the B section where we do the narrative, which is not the focus of tonight. I have done some narrative over my shoulder, as you can see, but you can guess that the main thrust of this evening is to get the numbers sorted. What numbers? Well, there's 4 phrases over my shoulder, all of which are technical. So what we want to think about now is, what is this thing, consolidation? What does it mean to roll forward? And what are these two, acquisition accounting and equity accounting? Well, the first thing to say is consolidation and roll forward are the nicknames. They're what these things are usually called, to be honest with you. But the proper name for accounting for a subsidiary is called acquisition accounting. Bit of a naff name, but that's its name. And equity accounting is also a bit of a daft name, but that is the technical name for accounting for an associate. But how does it work? Well, it's based on roll forward. How does that work? Well, that takes us to our first question. As far as we are concerned, the class notes are essentially a bunch of questions that we're going to work our way through. As you can see, I've cheated. I have a paper copy here with me. I love a little bit of paper to work with on a Thursday evening, and that's exactly what I have. So I have the notes in paper. I imagine that you have a PDF saved to your... What I do when I'm doing this at home is I actually watch the videos. I don't watch myself, by the way, but I watch Paul Merrison, who's doing P7. And when I'm watching Paul Merrison doing P7, what I do is I have the... what do I have? I have the... what's that thing called? Laptop, of course. A laptop to actually watch the presentation itself, the recorded presentation itself. And then I have my notes. Usually, if I'm honest, I have them on my phone, which is a bit naff and a bit small. But if preferably, I have it on an iPad. So I'm imagining you have your notes there on your iPad. I'm imagining. But I have paper. But I also have this fella here over my shoulder. And I opened it just a moment ago, so I'll open it again. There it is, Chapter 1, Basic Groups. Now, Chapter 1, Basic Groups, it starts by, working its way through the contents, telling you the contents, and then it's got a little bit of an introduction on relationships. You can see that just over my shoulder. And then, here we go, there's the question, pedal, saddle, handlebar, and that's the one that we're going to be working. I don't like this size. It seems a bit cramped to me, so I'm going to see if I can open it up a little bit for you there. So how would I do that? Page, would you think? Not page. View. View zoom. Page width, I would have thought. There you go. Fantastic. So we're going to work through this question here. And I do have a paper copy here. I might as well find out what page number it is. It'll be at the bottom there, won't it? And on my version, it's on page 20, and I imagine it's on page 20 of yours as well. So let's get page 20 of the paper. So I've got that open for myself. And we're going to work through this question to find out what equity accounting is, to find out what acquisition accounting is and how that works. So there we go. At the bottom of page 20, we have the requirement. It says prepare a consolidated income statement, otherwise known as a profit and loss, and prepare a consolidated statement of financial position, otherwise known as a balance sheet. And you've guessed that when you're asked for a P&L, the majority of the marks are on the P&L. And when you're asked for a balance sheet, the majority of the marks are on the balance sheet. It's true. However, there is a very strong culture. There is a very strong culture of the examiner giving marks allocated to a particular working that is required up front, and that's the first one that we're going to calculate. It begins with G. I'm just interested. Tell me again which thingamabob beginning with G we calculate first. Yeah, great. Good stuff, guys. Good stuff, guys. I have to say this, guys. I can see an IFRS number up on the board, and it was from Troy, who's made a good guess at the IFRS related to groups, but the two that we were talking about earlier are not the IFRS that you were referring to, Troy. So don't guess your IFRS numbers. If you want to know, the IFRS on control is IFRS 10, and the IFRS on influence is IAS 28. Okay, but it doesn't matter, it makes no difference, but what does make a difference is don't guess. Troy got quite close. He said IFRS 3, and IFRS 3 is the IFRS on goodwill. So he was close, but don't guess your IFRS numbers, right? There is no mark for getting it right, but some markers, I know, some markers will take a mark off if you get the wrong IFRS, so don't guess. If you're not sure, don't guess, okay? So here we go, we're doing groups. And we're going to do a P&L and a balance sheet, but first of all, we're going to do goodwill. And within goodwill, there is a particular figure that takes a bit of calculation. So there's a very strong culture of calculating this first. It's called net assets. So what we do is we go net assets, goodwill, balance sheet, or we go net assets, goodwill, P&L. And I use the right word there, or. Actually, in the examination, it is one or the other, and not and as it is here. But of course, we don't know which ones it's going to be coming up in December, and therefore we're going to do both. Okay, so it won't be a P&L and balance sheet, it will be one or the other, but let's do both because we can. Okay, starting with net assets. And here we go, we're going to start with net assets, off we go. So question, pedal. We're going to start with net assets. But before we get into net assets, we're actually going to do a group structure for this fella, because I want to reinforce the ideas that I've just communicated, control and influence. So here we go, let's have a P. It's awful, I really don't like this pen. S and A. And I'll take you back to the question and highlight the ownership percentages in case you missed them. They're not completely obvious, but the examiner did have a what would you call it? A culture? You could call it that. A culture of communicating ownership percentages on the face of the balance sheet not so long ago. He doesn't tend to do it so much now. Tends to communicate it in the narrative. But if you see that there, can you see there's two figures there? It's quite good, isn't it? You can see 80% and 30% for S and A already, so we can pick up that information. Okay. So let's drop that in to a journal note. So we've got 80% and 30%. And those are just ownership percentages, and we want to convert those into relationships. Now, relationships are between people, and in business, the primary motivator between people is that scary emotion, fear. We're talking about fear here. Now, the directors down in S, will they fear the directors up in P? The answer is yes, because those directors up in P have the power to sack the directors down here in S. There is legislation around the world which requires a purely majority resolution in order to sack directors. So can P directors sack S directors? Can P sack S? Absolutely. So when P says jump, S will say how high. And that jump how high, that is called control. It is the power to direct activities. So P will have the power to direct the activities of S. The relationship is therefore control. I feel like having a green here for control. So control, there we go. But if we said the same thing, jump to A, would we get an instant response from A? Control is the power to direct activities instantly without any back chat from the subsidiary directors. Do we have that kind of relationship with A? No, we do have we're going to be able to make ourselves heard because we have 30% of the voting power. We can't sack A on our own, but all we need is another 21% of the other guys, and we'll have 51%, and we will be able to sack the A directors. Therefore, we will be able to make our voice heard. And the technical name for that is called influence. So the question now arises, I like to ask it like this: which is the group? Is it the green or is it the red? Is it the green or the red? I'll probably answer it before you've had time to answer me. It's the green. It's the green. Now the idea is that the ISB have used a phrase for associate to make it sound like an outsider, a very close outsider. Associate is intended to sound like a close outsider, but fundamentally a close outsider is still an outsider, and the effect of this in a real exam question is very profound. What happens is you basically ignore the associate. This is a baby question, it doesn't quite work like that here, but in the real exam you can ignore the associate. You probably choose not to because the associate is too easy marks, if I'm honest with you, but you could ignore it. Okay. Let's get into the net assets then. Let's get into the net assets. Now, there is one great thing about the crazy 35 marks that you're about to encounter in P2. Those 35 marks for an hour are intense. There's no doubt about it whatsoever. You'll have the busiest hour of your entire life in December when you're trying to bash out the question. It'll be parent by sub, sub by sub-sub. The sub-subs are foreign sub-sub, and also there's errors in deferred tax, there's errors in lease accounting, there's errors in share-based payment, there's errors in financial instruments. There's kitchen sink chucked into this huge question for 35 marks, but at least you get one thing, and that's abbreviation. So we're going to abbreviate as much as we can, starting with NA for net assets. Then we're going to measure the sub at two different points in time. ACQ is, of course, acquisition, and YE is, of course, year end. And from that, we will imply the growth in the entity. Okay? And the way that we do this is by measuring the share capital and the retained earnings at these 2 points. SC share capital and RE retained earnings at these 2 points. And then we do exactly the same thing for the associate. We measure its acquisition and at year end, and thereby imply the growth. In the same way, like that. Now going back to the question, the share capital at the year end is as follows. The share capital in the sub is 50. Can you see that? Now there is a rule in accounting questions which also applies in real life, which is once you get control of a subsidiary, its share capital freezes. It's more of a culture in real life than it is. It's certainly not a law in real life, but it is a very strong culture. Happens in real life as well. Once you get control of a subsidiary, its share capital freezes, and that is what does happen. So what we can say is rather cute. Because we know the year-end figure is 50, because this figure hasn't changed since acquisition, it must have been 50 at acquisition. Hang on a second. We don't even know when the acquisition was. Exactly. It makes no difference when the acquisition was. This figure is constant. 50, 50, 50 at any measurement point. And the same applies next door, so we can copy next door. There we go. 30 and 30. Okay. 30 and 30. And we're off. And then back into the question, we want the retained earnings at the year end. So the retained earnings at the year end are 310 and 440. 310 and 440. 310 and 440. But we also need this fella here, the retained earnings at acquisition. And now clearly we do need to read the rest of the question. So let's go back and have a look at the rest of the question. Now, getting into the narrative, of which there's very little, it says at the top, the following are the summarised accounts of pedal, saddle and handlebar for the year. We have an income statement with revenue and costs, and then statement of financial position with a balance sheet. And then towards the bottom here we have the shares in saddle and the shares in handlebar acquired on the first day of the year. Goodwill has an infinite life and has suffered no impairment. It's the group's policy to value the NCI at fair value. The fair value of the non-controlling interest in S at acquisition was 60. Going back to that key sentence that is of interest to me just at the moment, the shares in saddle and the shares in handlebar acquired on the first day of the year, which sounds like a ridiculous simplification for this baby question. I do admit this is a baby question, but that's not a simplification. Almost always acquisitions take place on the first day of the year, the first day of the current year. If not, they tend to be the first day of the year before, but usually the first day of the current year, just like that, just like that. Okay. Now that is good news because it avoids time apportionment, but it means that you need to know this trick. Can you see this line of retained profit brought forward here? I'll highlight something actually in orange first and talk about that. This thing at the bottom here is called a reserve movement, and it isn't actually formally part of a P&L report. The examiner just sort of cobbles it on the bottom of his P&L report because that's his style. Okay. But getting into this reserve movement, which is quite cute, it's quite a cute thing. Of course, that retained profit balance brought forward at the beginning of the year is just brought forward at the beginning of the year. That's all it is. But in this case, my face is just flicked up there. I can see myself talking. Okay, that's good, that's good. I'm still talking now. Wow, that's slightly weird. I'm watching myself in delay, chatting away. That's rather spooky. It's about a whole minute delay, maybe even longer than that. Yes, it's long. Wow, that's slightly weird. Back to this. The retained profit brought forward as at the beginning of the year is, of course, more than just the beginning of the year. It is the date of acquisition. Of course, what we're interested in is the sub and the associate, and not the parent. But you've got your 200, you've got your 300 as at the beginning of the year. Let's go for it. I'll just clean that up, actually. It looks rather crazy. And then go over here and drop it in. So let's do that. Have a little bit of that and that. Here we go. And where's my pen? I don't want bright green. That's horrible. So what did I say? 200 and 300. And in this baby question, that's it. There's nothing else going on. So we don't have to fuss around with other stuff. So we add down to find out how big the entity was at acquisition, 250. How big it is now, 360. And that gives a growth of 110. You know, the difference is just 110. And then we've got 330, 470, and a growth of 140. And you'll notice me scratching out this area here, highlighted in green. We will be using that area once we get into the real exam questions on revision, if I'm honest. probably not before then, because it relates to a very technical thing called split growth, which we're certainly not going for just yet. Okay? But the reason that we did this net asset working, was in order to get the net assets. Here it is, the net assets, 250, and in particular 250, but also the 330 as well. The 250 for the goodwill. Let's do the goodwill. Abbreviation continues here. So let's go through some of these phrases. I think I'll start with this one actually. FV, FV, FV just means fair value, what the thing is really worth. Okay. Consideration is what we paid for our chunk of ownership. NCI stands for non-controlling interest. We have control through our ownership of 80%, but that leaves a block of 20% who do have ownership but don't have control, and those guys with an ownership interest with no control are called the non-controlling interest, because they do have an interest but they don't have control. Good name for them. And then of course this thing here at the bottom is net assets, and it's the thing that we've just worked out up there, the 250. Okay. Now in the real exam things get pretty complicated, and I find it very useful to have a standard presentation for my goodwill, and it perhaps does seem a little bit naff in a question like this that's a real baby question, but I find it really, really useful to reinforce the ownership percentages of 80-20, because you see you'll have 2 subs or maybe 3 subs and the ownerships will be changing. I find it really just so useful to reinforce that while I'm doing it. Working, I just find the working great, because there's always something crazy going on, you know, like the classic one I always say is you can have a foreign sub, or you can foreign consideration, foreign sub, you can have foreign consideration, or you can have deferred consideration, or you can have foreign deferred consideration. So, you know, you're probably going to need that working. You're probably going to need it. But in this case, I do admit you don't need it. Okay, so the reason we did that schedule up there for net assets was to give us the net assets of 250. Let's copy them down. There we go, 250. And speaking of copying, let's copy the rest of it. Now, there's no doubt about it, if you have done these kind of questions before, it does advantage you, because you'll know where to look for the NCI. Here is the NCI at the bottom of the question. Back to the question here, I'll just get rid of that colour because it's slightly distracting. There we go. And I'll just highlight it here in, you know, orange. There we go, 60. Fair value of the NCI, 60. Lovely, thanks very much. So 60, I just copy that, there we go, 60. And the fair value of the consideration for the purchase of our 80% is found in the same place every time. So let's go back to the question and highlight it. So I'll just get rid of that actually. I find it easy if I get rid of things as I go. Can you see this 260 here, that 260 there? That froze at acquisition. So that is what we did spend 12 months ago on buying the 80%. So that is the original historical cost, which at the time was the fair value. Okay, so 250. Did I say 250? I don't think it is 250, is it? 260. 260. There you go. And you add down, you get goodwill of 70. There we go. So this 70 is the fair value of the people. Oh yes. What this IFRS does, IFRS, who knows, who cares, it splits the business between people and things. It's a clever little fella. All businesses are made up of people and things, but the fair value of people is almost impossible to measure in a going concern. Now, what people are we talking about? Well, of course, all businesses have got lots of people. There's me, of course, there's the production staff just through this wall. There's the administrative staff downstairs on floor 3. There's lots of people. The real people that we're talking about, the real value of this business in terms of the people is you guys, the customers. So this thing, goodwill, is the fair value of all the people. But thinking of all the people can be a little bit nebulous, and so it is easiest if you take the shorthand idea that the people we're talking about is the customers. So it's the fair value of the customers, essentially. So what is the fair value of a customer in a going concern? What is the fair value of you, Troy, at this moment now? It is almost impossible to measure your fair value. But all businesses are made up of people and things. Things are always measurable. You can get a surveyor to survey the buildings. You can get a financial analyst to give a fair value for the financial instruments. You can get fair value for all the things at any point. But you can even get the fair value of the people at an acquisition, because we know that we spent 260 on our chunk of ownership. We know that the other chunk of ownership was worth 60 12 months ago when the transaction happened. So at that point, we knew for a fact that the business was worth 320. Because what's a business worth? A business is worth what someone is prepared to pay for it. What is a coffee worth? A coffee is worth what someone is prepared to pay for it. And I must be honest, this isn't a coffee, it's a cup of tea. But when I originally bought this, I paid, what did I pay? £1.60 I think I paid. No, that's wrong, isn't it? That's a cup of tea. £2.60 for my big coffee. So my big coffee cost me £2.60. What was it worth at the point that it was handed over to me? It was worth £2.60. Because stuff is worth what you pay for them. So if we bought the business for 260, our chunk of the business for 260 12 months ago, what was that 80% worth 12 months ago? 260. What was the 20% worth? 60. So as a matter of fact, what was the business worth 12 months ago? It was worth that 320. But what's the business made up of? People and things. All businesses are made up of people and things. All businesses are made up of people and things. So if we can get the fair value of the things, then we can work out the fair value of the people as a balancing figure. And that's the idea of what's going on there. So which is this? Is this a people business or a things business? Hang on, Martin, wait a second. That's a daft question. All businesses are all people and things. It's impossible to have, a business without having people. It's impossible to have a business without things. Good point, you're absolutely right, but that wasn't really what I meant. Which is it more? Is it more a people business or more a things business? Have a look at it. It's actually really easy to identify, isn't it? It's 250 in things, 70 in people. The figure 250 is bigger than 70, so fairly obviously this is a things business. And I like to take this one step further, actually. Is it a mass manufacturer or is it a college? Which do you think it would be? Now, of course, it doesn't say in the question that it's either, but if I gave you a choice between those two, mass manufacturer or college, which would it be? It'd be a mass manufacturer, wouldn't it? Of course it would, because it would be a things business that still has people, but it's mostly about the things. Okay, so that is what that schedule is doing, which, to be frank with you, many students don't know until they get to this point. But now you do know it, you'll find that we use that information over and over again. Even tonight we're using it quite a lot. People and things, people and things. It's a massive part of goodwill. It's a massive part of groups. Okay, so we can slap the goodwill onto our group position statement. There we go, 70. And then we do the roll forward for the associate. Well done, Troy. You picked that up. Yes, it's a things business. Well done. Now, roll forward is a little working I'm going to do in this brackets here that you can see. But actually, if I say it quickly and then slow down, it's strange. It's actually easier to understand if it's said quickly. What we do is we measure the associate at the year end as being approximately worth at the year end the same as it was at the year start plus the growth. That's the idea. We say approximately the year end fair value is roughly what it was at the year start plus the growth, giving us a little equation: acquisition plus growth. These lines are very narrow. These lines are now the law. I am not allowed to change these lines. They have to be this size. But it feels like a bit of a squeeze to me, to be honest with you. But that is the law. All of us lecturers must lecture to this line width. So I do hope you can read that. It says acquisition plus growth. And we now need to find out what the associate was worth at the year start when we bought the 30%, which brings us back to the question. Now, oh, that's nice. Can you see the 260 I've got highlighted over my shoulder? That figure froze 12 months ago at acquisition. So what is the investment worth now? I don't know. I just don't know. But what we do know is that the investment of 80% was worth 260 12 months ago when we bought it. What the sub is worth now is harder to say. But what the sub was worth at acquisition, what the 80% was worth at acquisition, was 260. That's a fact. And it's the same kind of factual thinking that we have about the red here. That figure of 120 froze at acquisition. So it's true, it is 12 months old and isn't what the 30% is worth now, but it's a good start point. And that's the way the IFRS works. It says, come on, start with the 120 and see what you can make of it from there. All right, let's see what I can do. Well, I tell you what, the associate has grown since we bought it, and therefore surely there's an element of plussiness going on here. Surely there has to be a plus here. Surely the growth is going to make the fair value go up. Surely. Yeah, but how much? Well, let's go back and have a look at the growth in the entire entity. Where do we do that? Oh, I've got there, don't I? So that means going up here. Oops, I didn't mean to give myself a green blob there. I go up here. Of course I do, obviously. To this 140 here. Now this growth thing here, it is literal, you know. The entity used to be 330 and now it's 470. And it's bigger, so it's grown. Now that growth is the growth in the whole 100%, in the whole entity. And therefore of that growth of 140, the component that affects our 30% is 30% of that 140. 30%, 30% of that 140. And that gives us 2842. And the 42 is slapped on top of the 120 to give us 162. Now, we're not completely daft. We don't say the associate is worth 162 at the year end. But what we do say is that's some kind of approximation for roughly what it's worth. It definitely was worth 120 at the year start. It's grown, and we think it's, you know, the 30% is worth roughly 162 now. And that's the idea of roll forward. So why is it called roll forward? Because you start from a definite known measurement point and then you roll forward for the time element. So it's called roll forward because you roll it forward. But this particular form of roll forward is also called equity accounting. Why is it called equity accounting? Now that's an interesting question. The International Accounting Standards Board asked the question, why is this equation up here called equity accounting? And they couldn't find out. It picked up its name just after the end of World War II, and at that time no one was writing down the reason for what they were doing, so no one knows. No one knows why it's called equity accounting. It's just a name that it's picked up from just after World War II is when it got its name. Which brings us to consolidation. Consolidation is what we're going to do with the net assets over which we have control. This is consolidation, is adding across. Now what we do when we're doing consolidation is we add across for the parent and the sub. I think I'll do it this way actually. We're going to add across for the parent and the sub. I'm going to do it this way. Here we go. I'll tell you what I'll do this. This is a really nice way of doing it. It's a bit overblown possibly, but it's a really nice way of doing it. Let's go up to the P&L and start with that. What we're going to do is we're going to do it wrong first. It is mathematically possible to do consolidation using ownership. What you would do is you communicate like this. This is not what we do under IFRS 3 is actually the rule if you want to know the rule. Under IFRS 3 we don't do this, but it is mathematically possible. 100% of that, 80% of that and 30% of that would work mathematically. However, there are a large variety of different ways of doing group accounting, and that is not the way that it is done on this planet, in this life. What we do is consolidation based upon control, and control is an on-off switch. I tell you what, can actually reach a light and turn it off and on. That'd probably really annoy the producers, wouldn't it, if I did that? I don't want to actually wreck any of them. They've taken away all the light switches, so I can't noodle with it. It's probably very sensible. There used to be light switches on this, but now they're all in the wall and only in the wall. Well, you know the principle of on and off. When on, you describe the onness as being on, not 100% on. When a switch is off, you don't say it is 0% on, you say it's off. And it's like that with control. With control, you have all or none. The words are all or none with control. How much of the revenue in P did we control over the year? We controlled all of those sales. How much did we control in S? We controlled all of them for the entire year. And how much did we control in A? We had no control. So it goes all, none, all, none, all the way down the P&L, and exactly the same on the balance sheet. So now coming to the balance sheet, which is the figures we really want, how much of the net assets of 390 do we control? All. How much of the 360 do we control? All. And how much of the 470 do we control? None. And that process of just going all, none is called consolidation. So we go 390, 360, there you go. So 390 plus 360 gives 750. And I'm cheating, I did this on Tuesday night, so I know the numbers. So it's 1280. Yeah, this sounds right. 982, that sounds right. And in the exam you add across, but not down. In the exam you add across, but not down. Because there's no marks in the exam for adding down. But here in the classroom, just to make sure my numbers are making sense, I am going to add down. Then into the bottom of the balance sheet, we communicate the share capital to the group shareholders. The group shareholders are called shareholders because they hold shares, and the shares that the group shareholders hold is the parent shares. So you tell the group shareholders what shares they hold, which is the parent figure of 100. And then you tell those same shareholders what money they made for retained earnings. And you tell them what they do control but don't own, the non-controlling interest. And there is a very strong culture of fresh new brand new page for these two. Retained earnings and non-controlling interest. So RE parent subgrowth, associate growth. Like that. So what are the profits in the parent balance sheet as at the year end? Should we go and check that out? I think that's probably behind my head actually. I'll just bring that up. So where are we now? Into the there we go, into the notes. Just get rid of those two red blobs. Here it is. Can you see the pink figure of 100? That's the parent share capital. And just next to it, can you see the parent retained earnings at the year end? So what are we saying? 670. 670 is in the parent balance sheet at the year end. How much of that is attributable to the parent? All of it. But now we go and have a look at the subgrowth and indeed the associate growth up here. I've highlighted one in green already, so I'll just reinforce that. Highlighted one in green already. There we go, in green. And just next door, 110. These two guys here are the growths in the entities. But how does an entity make growths? By making profits. So these are also the profits in the entities that have been made since acquisition. The figures are 110 and 140. But of course, we're talking to our shareholders now. How much did our shareholders make out of this? Well, how much was our ownership of this? It was 80% of one and 30% of the other. Yep. Giving us 88 and 42, and therefore 800, like so. And then the non-controlling interest, the NCI, is also measured using roll forward. Is also measured using roll forward, which means we measure the NCI at acquisition and then we factor in the sub growth. I seem to love using a bit of red here when I do this. I always seem to use red, so I might as well. Up again into the net assets and goodwill. Hopefully this will work. It doesn't work very well here because I've split across a page, which is a bit annoying, but it can't be helped. Just get rid of that colour because it's a bit distracting. Goodness me, can't get rid of it. There we go. It's a bit distracting. The fella that I want here is this fella here, this 60. So that 60 is what the NCI was at the year start. There's the 20% right there for us. And if we go up there, we've also got the growth of 110, straddling a page, which is a bit awkward. But I'm sure we'll cope. So 60 at acquisition. And we had, what was it again, 20% of 110 gives 22, 82, wazza. And then we take those two fellas up, 82, 800, 882. We take them up and slap them on the face. 882 gives 982. And the balance sheet balances. What's the chances of that happening in the exam? Absolute zero. And there you go, it balances. And it kind of feels like this question is finished, but it isn't. We have to do a P&L. But while I'm on the balance sheet, I want to do this. I want to show you NCI on the face. Same numbers, but on the face. Because I want to point out something. You've probably figured out. Like that. You probably guessed what it is I'm trying to highlight to you. I'll literally highlight now. These two are the same, aren't they? These two calculations are the same. Do you see that? They're identical. These two calculations are identical. How do we describe associate accounting? Roll forward. How do we describe NCI accounting? Roll forward. However, roll forward when applied to an associate has its own special name, which is equity accounting. They're actually both the same, aren't they? But it's not called equity accounting for an NCI just because it isn't. But all equity accounting is rolling forward as if it was NCI. All equity accounting is rolling forward. And these two are effectively the same. So Martin, why did you show a separate working for NCI when it would have been easier just to do it on the face? Well, there's two reasons. First of all, there's always two subsidiaries. There's always two, sometimes three subsidiaries, but there's always one associate. That's the first thing. It's a matter of space. But probably more importantly is the culture. The examiner has this way of presenting it, the NCI, this way of presenting the NCI. So if we copy his presentation, then we're more likely to keep the markers sweet. So we're doing it the way we're doing it because that's the way the examiner does it, basically. Okay? Great. I'm just watching myself catching up, but I can see what's happening there. It's quite nice. That's quite nice. It seems to have caught up the video a bit as well. Good, 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 good. Group profit or loss. Here it comes. I have to be honest, guys, I'm feeling a little lonely. There's not been a peep out at you guys for the last, I don't know how long, 10 minutes, 15. So just to make sure that you're still alive and kicking, would you give me a little bit of alive and kicking on the chat there, and I'll feel much happier. I'm feeling rather lonely. Please, if you would, tell me you're alive and kicking, and I will feel content about it. In the meantime, I'll show you the classic way of presenting the group P&L, which is like this, with columns. It's the culture. You don't have to. Anything that works for you will work for the markers. Wow, great stuff. You're still there. Good stuff, good stuff. Excellent, fabulous. Thank you, guys. I can see lots of alives and kickings. Wonderful. Hold on, Martin. Where's the associate gone? I'll show you where the associate... What's this thing, ADG? This thing, ADG, over here, is for adjustments. It is short for adjustments. And they're relevant in other questions doing the P&L. They're actually essentially just one thing, which is when the parent sells to the sub, or indeed the sub sells to the parent. And they're commonplace in P&L questions, but this is a baby P&L question as a consequence of which we don't have any adjustments in this question. You certainly do once you get into, just beyond this, but in this question, none, okay? So we're going to communicate control. We've already shown what control is. So 500, 400. Gives 900. Then operating costs. Is 200. 210 gives 410. You can say I'm just copying, aren't I? There's no marks for operating profit. There's no marks for adding down. And on a P&L, there's no point in adding down because it doesn't balance anyway. So we have this abbreviation, OP. What does OP stand for? Operating profit. Where's the associate? what I want you to do is go slightly insane when you get to the operating profit. Sure enough, I do want you to abbreviate operating profit to OP, because there really is no marks for the OP. Therefore, abbreviate the labelling and scratch out the total. Don't actually calculate the total. But use it as a reminder for the associate, because the truth is that there are two, I mentioned this before, didn't I? There's 2 marks for the associate. Now, there's 2 marks on the balance sheet and there's 2 marks on the P&L. And both of them are frankly dead easy. But this one in particular is dead easy to forget. So when you write operating profit, where's the associate? Immediately say to yourself, where is the associate? And go slightly crazy about it, because you do not want to forget these 2 marks, because all you do is pick up the PAT and multiply by the ownership percentage of 30%, and there's your 2 marks. It is probably the easiest 2 marks in the entire exam. Picking up the PAT is not difficult. What you do is you go to the tax and look just below it. Here we go. You can see I've gone back to the question. So I'll just get rid of some of this colour, which is a little distracting. There we go. Of course, what we want is the associate column, so there it is there. But once you have the associate column, you pick up the tax and look just below. Profit after tax is literally, you get the tax, and just below 140, as you can see. So 140. So 140. What are we doing there? Yep, 140. And it gives us 42. Now, this is actually what's called a parent associate, because the parent bought the sub and the parent bought the associate. Okay, so associate, where is it there? So the parent bought the associate, but it is actually possible for the parent to buy the sub and then the sub to buy the associate. You see that? So it is actually possible to have a sub-associate. It's not very likely. It's not very likely, especially this winter, but if it happens, all you do is have the same number and move it across. All right? So same number, move it across. If it is the sub that bought the associate, same number, but move it across. Okay? A P&L goes operating, financing, tax. Operating, financing, tax. So now financing, which is the interest. $50 and $70. Sorry, 50 and 20. My apologies, 50 and 20 gives 70. Which brings us to tax, and therefore PBT we abbreviate. And we don't calculate because it's got no marks. Then the tax, 80 and 60. So 140, yeah. And then we have the profit after tax, which is worth no marks. And then we have the non-controlling interest. That must be behind my head by now. I'll bring it up. Let me bring that up. That must be behind my head, right? I'll have to play around with that a little bit, actually. What shall I do with that? Change the scale might be quite nice if I'm feeling quite clever. Do I want to risk that? Should we try, see what happens there? Oh, there you go. That's all right. If I can flip between those two, that will work for me. So I've minimised this now because what I want to do is talk about how to calculate this fella here, the NCI. Clearly we're going to multiply by 20%, but the question is, what do we multiply by 20%? Well, all you do is just add down in this column here. Literally just work your way down to get the blue fella. That's all you do. So 400 minus 210 gives 190, minus 20 gives 170, minus 60 gives you 110. So the figure is 110. Drop it in, 110. You multiply that by 20% and you get 22, and that's the NCI, and that's worth 1 mark. It's actually worth 2 marks because there are 2 subsidiaries, and you get 1 mark each time that you do this. But there's There is no mark for actually getting the 22. The mark is for the process of adding down. Now, if you have a look at this question here, you will notice that the original profit on the original P&L is also 110, which makes you think there might be a shortcut there. But that shortcut is unlikely to work because there'll usually be something going on in the sub. There might be a half-year acquisition, so time apportionment. There might be a provision for unrealised profit. There might be both. But there is no mark. There is no mark for actually getting the 22. The mark is just for the process, which is adding down and multiplying by the appropriate percentage. And you get it twice. And then when we get to the bottom, what's left after deducting the non-controlling interest is our profit, the profit attributable to members, otherwise known as PAM. That's quite a cute name, isn't it? PAM. And I'll get in there and write that in full right now. So I'm going to go page width. How do I do that? Oodly doodly. That didn't seem to work. Try view. Oh, there we go. Page width. Yeah, that's going to work, isn't it? Oh, lovely, lovely, lovely. Profit attributable to parent members is the full name, for which you get no marks, and that's why I use the abbreviation PAM, standard abbreviation PAM. And it's rather cute because it gives us the little mnemonic, which is who sits between Pat and Pam? NCI. Who sits between Pat and Pam? NCI. Hello, girls. I find that quite useful. And that's the end of that question. Only it isn't. We're going to get a slight reprise to that question when we ask the question, how is goodwill accommodated? And the answer is two different ways. So we're finished with that question. We're finished. So we can roll off, we'll do a little rolling off. And we'll come to a new subject of goodwill policies. Goodwill policies. Because there's two, you see. Great. There are two. And they're called full and partial. And I'll just have a quick look on the chat, see how we're doing. Also, I'll blow my nose because yeah. Yes, indeed. Operating profit. Where's the associates? There's a little bit of a chat as to where the associate balance should go. It is immediately after operating profit. That's what the IFRS says. Also, sometimes your examiner is not so strict as he should be, but that is what the IFRS says. So, here we go. Full and partial. Full goodwill. NCI is measured at fair value. Very simple. Partial goodwill. NCI is measured at NCI proportion of net assets. And it is a slightly longer sentence, implying it's slightly more difficult, which is true, it is slightly more difficult, but not enormously difficult. So what I suggest we do is we revisit the question pedal, saddle, handlebar and recalculate the goodwill for saddle. Just do it both ways. Oh no. The question is called pedal, isn't it? Revisited. I haven't given myself much space here. Do I need it? I'll probably fit in there actually. I didn't mean to squeeze, but it'll probably work okay. Yeah, it should do. I didn't mean to squeeze, but seems to fit. Wait a second. We've already done goodwill once already and got 70. Which goodwill was it that we were doing? It's a good question, isn't it? Let's go back and have a look at the question itself and see if we can answer our question with the examiner's question. Here's a phrase that we did look at, but we barely did more than just look at the phrase. It is the group's policy to value the NCI at fair value. We glanced over that phrase, but if I focus in on it now, you can tell that there is an element of choice. And it is true, policy implies choice, but not your choice, the examiner's choice. He can either choose full goodwill or partial goodwill. And in this case, he went for fair value. Fair value NCI is parallel with full goodwill. And indeed, he gave the NCI fair value was 60 just immediately below that, didn't he? And we're going to copy that information again and get the same figure of 70. We're going to get the same figure of 70 here. Of course we are. In fact, lots of the data is constant. Like, you know, the 250 that we paid, 260 that we paid for this fella, that's just a fact. The 250 that we got from the net asset working, that's just a fact. But what is not fact, but is in fact a matter of opinion, is how to measure NCI. And we can do it one way or the other, depending on the policy. Now, we don't have a choice. The examiner tells us what he wants us to do. And in this case, he told us he wanted to do full goodwill by using fair value NCI, and he gave us a figure of 60. But had we been doing partial, it wouldn't have been that hard. You just bring these two fellas together, like that. In the working column, you see, we do use the working column to do a working, something like this. Hope that's not too small. Does feel a bit squeezed. 20% of 250, 20% of 250 gives us 50, and by having a smaller NCI, we of course have a smaller goodwill of 60. So which one's coming up in your exam? Well, frankly, most likely it will be full goodwill. The examiner is a big believer in full goodwill, and therefore very reasonably he does full goodwill almost always, almost all of the time. But partial goodwill is in the IFRS, and his view is if it's in the IFRS it should be examined sometimes, and I think he's right, to be honest with you, and therefore you can see partial goodwill is done that way. It's not particularly difficult, so it doesn't make much difference really which one he examines, but it is usually full, which is slightly easier. It's the copying one. Okie doke. Great, great. And yes, the examiner will always tell you which policy he wants you to use. Okie doke. What's that then? That is the end of that. Not much to say on goodwill policies, but we're not finished with goodwill because we are moving to goodwill impairment. How are we doing for time? Really well, really well. Goodwill impairment. This occurs when sub-carrying value oh gosh, it's really hard doing this. I'm struggling a little bit because the pen's not what I'm used to. This occurs when the sub-carrying value is above the recoverable value, which is the higher of blah and blah. And blah is VIU and FVLCTS. Bit of an alphabet soup, that second one, but does anyone know what VIU stands for? Just thought I'd wait for this. Gives me a chance to have a sip on my tea, doesn't it? Oh, maybe you don't. I have a feeling you've had long enough to answer. It stands for value in use. I thought you might know. I don't know why I thought you might know. Value in use. And it's just literal. It's the value that you would get out of using the asset, whether it's a car or a brand, or in this case, a whole subsidiary. It's discounted cash flow based on, the future productivity of the subsidiary. It's that kind of thing. It's quite a complicated number to calculate, but in the exam it's given. And if you don't know one, you probably don't know the other, which is fair value less costs to sell. And it's very, very closely related to net realisable value. It is how much you would think you would get for selling your subsidiary less the transaction costs of selling the subsidiary, the auction costs, the banking costs, those sort of costs. So fair value less cost to sell, and you choose the higher of those two. The reason that you choose the higher of those two becomes obvious when you do a question. And there are two questions that I want you to do here. One is just the baby question. It's called Fake and Stock, and it appears on page 22. And just over the page is the real one called Question Terror. Okay, so fake and stock first. Question fake and stock. Lovely. Page 22, question fake and stock, which I do have in a screen behind me, but I think I'll just go for the paper version for this question because it's quite a nice baby question. However, it's not easy this because there was a question that just disappeared up there. But it asked the perhaps obvious question, which is partial still permissible? Acceptable was the word that was used. I might just scroll back if I can, and if I'm able to do that. Wada bada boo ba boo. Will you let me scroll back? Is partial still acceptable under IFRS? Asks ABS. The answer is obviously yes, because the examiner examines it. But it depends what you mean by acceptable. The examiner doesn't like it, but it is permissible under IFRS. It's largely discredited, and I think there is a flavour of that in your question, Abs. You're like, huh? Partial's a load of rubbish. Surely no one is doing it. I haven't seen any research actually recently in who is doing what under IFRS. However, I did take a quick look at financial reporting for goodwill shortly after the adoption of IFRS 3 2008 by the European Union, which was in around about 2010, 2011. And most entities were adopting full goodwill, which surprised me actually, because full goodwill is actually quite hard work. It's expensive because in the exam, you get given the fair value of consideration. You get given the fair value of NCI. You get given the fair value of NCI. But in real companies, you're not given the fair value of NCI. You have to value the fair value of NCI using valuation techniques. And there are shortcuts, it must be admitted, but it is kind of implied by the IFRS that you're expected to get a financial analyst involved. And therefore there is some expense in doing full goodwill. And yet that was the policy that I saw in the FS that I looked at. I looked at lots of FS, but I won't say I did any proper research. I've never actually seen any research as to who's doing what, but I didn't see any partials. So I think it is largely discredited, but it is still permissible, and therefore if you give me some examples of people who are doing partial, I'd like to hear from you. It'd be interesting to hear if you can give examples of people who are doing partial. It is cool, they can do it, it is permissible by the IFRS, and there's certainly one person that does partial occasionally, and that is your examiner. Okay? And you can do it too. You bring those two numbers, you multiply together, off you go, there's your NCI. Back to Fakenstock. So a parent Fakenstock bought 100% of the equity of a sub at the year start for 900. Share capital was 100 at acquisition. Retained earnings were 400 at acquisition. And retained profits for the year were 200 retained on top of that. Goodwill has an infinite life, and an impairment review of the sub at the first year end revealed a value in use of one figure and a fair value less cost to sell of another. Great. Let's do it. Oops. How are we doing for time? Still doing good. Really nice. So share capital, retained earnings, all the abbreviations you know, acquisition year end, share capital freezes at acquisition, it was 100 at acquisition, so 12 months later at the year end, it's still 100. Retained earnings grow day by day. And over the year they grew by 200 and therefore are 600 at the year end. Giving us 500 and 700 and therefore growth of 200. And we're not doing split growth, and therefore the growth is just the growth. Goodwill. So we have 100%, 0% for the ownership split. Did you notice a parent vacant stock bought 100% of the equity in a sub at the year start for 900, so it's 100%, 900, and therefore 0% for the NCI, and therefore 0 for the NCI. Net assets, we pick it up and drop it down, 500, and we get goodwill of 400. And you can see, perhaps I'm overcooking it, but you can see that all businesses are made up of people and things, and this business is roughly 50-50. It's got slightly more things than people, because 500 is slightly bigger than 400. But all businesses are made up of people and things. Things are measurable and remeasurable at any point in time, but people are only measurable at the point of acquisition and never again. So this figure of 400 that was 400 at acquisition then flatlined and didn't change for the whole 12 months. There's 12 months before the year end. There's 12 months before the year end. There's 12 months before the year end, 12 months between the acquisition and the year end when the impairment test takes place, and that 400 just flatlines. So that 400 was 400 at acquisition, and the following day and in the middle of the year, and just yesterday it was still 400, and this morning it was 400, okay? And then we impairment test it. And when you have an impairment test, you always have an impairment, pretty much always. To give us the final goodwill that we slap onto the balance sheet. And to do this impairment test, what we do is a separate working, actually, on the whole subsidiary. What we do is we compare the carrying value to the recoverable value. We compare the carrying value to the recoverable value to give us the impairment as a balancing figure. Like so. So what do we carry when we carry a business? What is a business made up of? It's made up of people and things. So goodwill and net assets. So goodwill and net assets. And the thing is about the goodwill at acquisition is it flatlined for 12 months and therefore is still 400 at the year end when we do the impairment test. Just check the impairment test is at the year end. Just read that second paragraph. Goodwill has an infinite life and impairment review of the sub at the first year end. Okay? Impairment tests are always at the year end, but just reinforcing that. But what we want is the net assets at the year end. At the year end, which were 700, as you can see from just above, so 700, gives us a carrying value of 1100 for the whole sub. But what is the recoverable value? Well, it's got something to do with VIU and fair value less costs to sell. Something to do with those two. So let's copy the figures. 780 and 350. And we choose the higher of those two. But why do we choose the higher of those two? It's got to do with human behaviour. This is our sub, and what we can do is either use it or sell it. And it's our sub, and it's up to us. We can do either. We can sell it or use it. Use it or sell it. If you had those figures, which would you choose? You do have those figures. Which are you going to choose? You're going to choose the 780. Why is that? Because it's the bigger figure. Why is that? Because that's human nature. What the IFRS says is you must use the higher, but the reason it says you must use the higher is it's reflecting human behaviour. That's all it is. So it's the higher of those two. But the higher of those two is still lower than the carrying value. So the carrying value is overvalued and we need to chop a bit off. And the balancing figure that we chop off is 320. But a business is made up of people and things. And which one are we going to hack into? Is it people or things? People or things? Well, it depends which one leaves the first. When a business is in trouble, who leaves first? The people or the things? It's the people, right? To leave us with 80. And you've guessed that this is a baby example and we need a grown-up example, and we've got time for it. We've got loads of time for it, which is great. Ah, you had value in use form. It was just a delay in the response, just a delay in the internet. Great, good stuff. Well done, guys. Let's do this question again, only more so, with 2 new techniques. I'm going to teach you 2 new techniques. They're called PUP and FVA. FVA and PUP. Number 1. FVA stands for fair value adjustment. Stands for fair value adjustment, FVA. And it's got to do with book value, accounting, stuff like that. You know what's going on with groups here. Basically, the whole thing is being dominated by goodwill. And what we want to do is try and get the fair value of goodwill. The reason we want the fair value consideration and the fair value of NCI and the fair value of net assets is we want the fair value of goodwill. We want a real good feel for the value of the customer base at the point of acquisition. We want the fair value, right? So fair value consideration tends not to be a big deal. Fair value of NCI tends not to be much of a big deal. But fair value of net assets is a very big deal because accountants tend to focus on balance sheets, and balance sheets have some fair values. When you buy a sub and it says it's got 3 million UK pounds in the bank account, then what's the fair value of that 3 million UK pounds? It's 3 million, isn't it? And it's the same with stock, you know. Of course it's cost, but it's only 2 weeks old, so you know the cost is roughly the fair value, which is cool. But as you work your way up the balance sheet, you get to the dodgy stuff, especially property, plant and equipment, especially property. Property, especially in the UK, appreciates. All over the world appreciates, let's be honest. Even in China, that's struggling at the moment, it's going to appreciate. All right, it might have gone down a couple of blips in the last couple of months, but it's going to go back up again. Property goes up. However, accounting for property is usually at cost less depreciation. So the asset value on the balance sheet is going down while the true value is going up. And a gap opens up between the fair value and the book value and the fair value. And the FVA fills this gap. And it's a fairly modern invention, actually. 1997, I think, was the year. It was adopted by IFRS, 1997. So it's a fairly modern invention. By my standards, I've been doing this guff since 1990. So by my standards, it's a fairly modern thing. But PUP has been around since before I was born. This really is going back to the early years of group accounting, just after World War II. PUP is provision for unrealized profit. And as an accounting twiddle, it is totally and perfectly reasonable. I guess you're going to be studying P3 with David Laws, and one of the very interesting things you'll be studying in strategy is acquisition strategies. Really fascinating subject. And one of the things you do is you buy your competitor in order to increase your market share within the market and maybe try and get a dominant position within a single market. But that's a bit dull. More acquisitions, better acquisitions, I think, are vertical integrations, which means buying your customer or buying your supplier. It's to do with, you'll go into this, it's to do with the value chain and all that sort of stuff, this Michael Porter kind of stuff. And it's just, of course, if you buy your supplier in order to get closer to the raw materials, of course your supplier will then supply your materials, and then you'll end up with the sub selling to the parent, right? And it's commonplace, the sub selling to the parent. But the sub has directors. I realise those directors do not have control, but they still have, a heartbeat, and you want to keep them motivated. So you permit your subsidiary to make a profit when it's selling to you. You can actually stop them if you want to. You can say, no, you can't make a profit when you're selling to me, and then they just get demotivated and they can't be bothered doing anything. So you don't do that thing. You don't say to them, you can't make a profit when you're selling to me. You say, you can make a profit when you're selling to me. And that keeps them keen, So it's really common to have subs making a profit when they sell to their parent, or indeed parents selling to subs and making a profit. It's commonplace. And it's good management psychology. There's nothing wrong with it. But it creates a problem, because when the sub makes a sale to its customer, which happens to be you, all right, makes a sale to its customer, the sub records a profit, which is right because it's made a profit. But from the group perspective, you can't make a profit from the right hand selling to the left hand. How would that work? You can't make a profit selling to yourself. So in order to remove this problem in group accounting, we have this twiddle, and it's a bit of a naff name, provision for unrealised profit. A better name would be adjustment to remove unreal profit. But still, that's its name, provision for unrealised profit. But we can flavour it appropriately, so that's what I'll do. This is an adjustment to remove unreal profit. On sales, on transfers, I'll use that phrase, on transfers within the group. It can actually be between fellow subsidiaries. But in exam questions, it's always between parent and sub, either in the direction sub to parent or parent to sub, either in those directions. And of course, this question has that. Let's go for it. This question, meaning question terror. Question terror. Let's go for it, guys. So we're going to do the net assets at acquisition at year end, and thereby impute the growth. And yes, you've guessed, we have share capital and retained earnings. Of course we do. but we also have an FVA and a PUP, a provision for unrealised profit. Into the question. A parent, Tara, buys 70% of a sub for 800 at the year start, when the share capital is 50. Retained earnings are 350 and an FVA of 100 is required on machines with a life of 5 years. The fair value of the non-controlling interest is 317 at acquisition. During the year, the sub made profits retained of 50. So the profits retained in the sub for the year is 50, and the sub sold goods valued at 12 to the parent with a margin of 25, 1/3 of which is still in inventory in the parent. Goodwill has an infinite life, and a year-end review reveals a value in use of one figure and a fair value less cost to sell of the other. It is the group's policy to value the NCI at fair value. Is that full or partial goodwill? It's full. How can you tell? Well, first of all, it says fair value, but it even says full goodwill. And the requirement is goodwill and NCI, starting with the net assets. So up to the top, a parent, Tara, buys 70% of a sub for 800 at the year start when the share capital is 50. So that won't have changed. Retained earnings were 350 at the year start. And did you notice 50 was retained for the year in the middle paragraph to give 400? And then back up to the top, retained earnings are 350 and a fair value adjustment of 100 is required on machines with a life of 5 years. So 100 on machines. And FVAs are generally depreciating or non-depreciating. This one is depreciating, of course, because it is on machines with a life of 5 years. And therefore the amount of depreciation each and every year is 5 years into 100, which is 20. There is in fact only 1 year. So we knock off 20, we minus 20 to give us 80. And that is indeed worth a mark. You know, it's a real exam standard 1 mark. Then the PUP, we bring the 3 figures together. I think I might actually highlight the 3 figures. For those of you familiar with this, you'll find those 3 figures very easy to get your head around. But if you're not familiar with this, it might be a bit of a jump in the dark. So let me highlight those 3 figures. You just bring these 3 figures together. It is the 12, the 25%, and the 1/3. The 1/3 is difficult to see because it's 2 words rather than a ratio. Great. So let's do that now here in blue indeed. So it's 12 multiplied by 25% multiplied by 1/3. Cha-cha-cha. Spots of black. Cha-cha. And it gives you 1. Ampacha! And there we go. Oops. A nice straight line. And there is 1 mark for that fella as well. And that's fine. And there's no requirement to show working. And that's fine as well, if you're very familiar with PUP, which I expect some of you are not. So let's just, for the benefit of all, but especially for the benefit of those who are less familiar with PUP, let's do some hand waving, right? So the sub sells to the parent, and the sub sells at a price of 12 million. So the parent buys at 12 million, of course. The sub sells at 12 million. And the question tells us 25% of that is profit. So the amount of profit hidden in the transaction is, or should I say was, 3. But that is what the profit was at that point. And from our perspective, from the group perspective, the whole lot was unreal. But what we don't want to know is what was unreal. What we do want to know is, of that unrealness that was unreal, how much is still unreal at the year end. Can you see that heading of year end? That's key, isn't it? Year end. So of course, the PUP of 3 attaches itself to the stock, and of the stock, 2/3 have disappeared and 1/3 remains. 2/3 have been sold and 1/3 has been kept. So 1/3 of the original 3 is still unreal at the year end. Okay, that's where we get the 1 from. And what we're saying is, let me do a bit of nice highlighting. I like going for pink. I went for pink on Tuesday with this, so let's do it again. What we're saying is the sub recorded a profit of 400, of which 1 is not real and the rest is real. That's why you can see a sausage round it, deducting the 1, right? Because the real profit is actually 399. So the sub recorded a profit of 400, of which 1 is not real and 399 is real. That's how that works. Good. And then we add down. So we get 400, 500, 529, and a growth of 29, which we don't split. And then the rest of this question is familiar. So this one was a 70-30 split. $800 we paid for our 70%. The fair value of NCI was 317, just copying straight from the question. And there's the 500 which dropped down there. $500. Which gives us 617, and that was the goodwill at acquisition 12 months ago. And what's happened to it over the 12 months? Now, I don't know, I think it's just flatlined for 12 months. Until at the year end, it suffers an impairment. Which is separately worked out in a separate working, which rather unfortunately seems to need a separate page for me, which is a bit awkward, but can't be helped. Let's go and do that separate page. Here we go. Here's the impairment review itself. Carrying value is people and things, otherwise known as goodwill and net assets. So goodwill was 617 throughout the year without adjustment. The net assets we want at the year end, 529. Someone has rather kindly left a calculator here. It's one of those big fat finger calculators that I really like. So I can jab my skinny fingers at this fat finger calculator. That's very handy. 617 plus 529. No need to use my brain there. 1146. I must admit, I feel like it's 11:46 at night. And here's the impairment calculated as a balancing figure by comparison to the recoverable value. But how do we recover value from our ownership of the subsidiary? There are two ways of recovering value. Those two ways are sell an asset or keep an asset and use it. Keep an asset and use it generates VIU. Sell an asset generates fair value less costs to sell. And we have those numbers as given in the question, which is 360 and 666, the number of the beast. And of course that's the number that we'll use because it's the higher. That's what we do. Shortly after the new year starts, we are going to sell this sub, I would have thought, because you can get a lot more for selling it. So 666, oh goodness, 114, I'll plus with calculators. 1146 minus 666 equals 480. And when a business is in trouble, who leaves first? Is it the people or the things? Is it the customers or the computers? It is the customers that leave first. So 480, we lop it off there. And minus 617. Should be able to do that in my head really. There we go, 137. And that would score you 1, 2, 3, 4 marks in any exam. Really, that would score you 4 marks, which means you have 6 marks so far. 1 for the PUP, 1 for the FVA, and 4 more for the goodwill. But we're not finished because we have the NCI. The NCI is another 2 marks. Having for time. Good, really good. NCI is, first of all, roll forward. Acquisition plus subgrowth. First of all, roll forward. So let's get that data. Oh, that's nice. It's nice and easy here. It's brought together. We've got 317, 30% and 29. 317, 30%, 29. I like that when that's together like that. So that's, where are we now? 317 and 30% of 29 is 8.7. But then we need 2 I's. Impairment and indirect adjustment. Now I'm getting slightly ahead of myself because there is no indirect adjustment. An indirect adjustment is what you do next week, because next week we have parent buys sub and sub buys sub. And of course, if we have ownership through the middle sub, the sub-parent, that is described as indirect ownership. And indirect ownership requires an indirect adjustment. So I will refer you to next week. So see chapter 2. Chapter 2. And indeed next week, we'll do that next week. But it's nice to have that there. I like having it there just to tell you there's more to this than just impairment. Oh, hang on. We're going to knock 480 off the top of the balance sheet in goodwill. And the balance sheet is called the balance sheet because it balances. Well, at least in theory, anyway. So if you knock 480 off the top, you're going to knock 480 off the bottom in accordance with the ownership percentages. 70% against us and 30% against these guys. Which gives us 144. Wow, that is a massive, massive chopping into the NCI. Massive. Probably should have done that in my head, but couldn't help. But pick up the calculator when it's sitting there begging me to use it. There we go, 181.7. Beautiful, 2 more marks. I'll give myself another couple of tickles there. Fantastic. And yes, the groups question is 35 marks. But yes, that really would qualify. That has qualified as 8 marks in recent exam questions. It's very, very commonly examined. Goodwill impairment, PUP, FEAs, they're all really commonplace in almost every exam. Fantastic. Which brings us to the end. How are we doing for time? Perfect. We're really, really doing well. Great. Excellent. Oh, I do apologise, guys. If you've been chatting away, I've just realised my thing has just stopped there. It didn't go all the way down. Oh, it sounds like you've been having horrendous problems with freezing and so on. I do apologise for that. I hope it isn't our end. The lecture must have been recorded successfully by the video production guys next door, otherwise they would have interrupted me. But yes, I can actually see Maz saying, I hope the recording doesn't freeze. I'm sure the recording is absolutely fine. The recording is of paramount importance to the studio guys sitting just, the production studio guys sitting just through this wall here. It's Sophia tonight actually who's on that job, and she would have come in and interrupted me if there had been any problem with the video recording. But it's nice to do this live, and I do apologise for those of you who found it really difficult to do it live. You've been extremely patient to stay so long with me, because you are basically now at the end. So we've now finished basic groups, and what I am going to do now is, I think what I'll do is I'll go big head actually and talk to you about some stuff. So I'm going to go big head, see if this thing works. There I am, big head, I imagine. I can't tell for sure here because I'm suffering a lagging as well. So welcome. My name is Martin Jones, and I am here to present to you on P2 corporate reporting over 16 hours, of which you have had 2. And I have a deal with you guys, and that is everything you really need to know. I am going to teach you, but everything I teach you, you really need to know. And now it's over to you, of course, for the weekend to make sure that you can sort this stuff out. Now, there is homework exercises in every single chapter. We're in chapter 1 now, and there's a particular favourite of mine called Hebrides, which is a wonderful question in the back of chapter 1. Just to make it absolutely crystal clear here and now, Hebrides and indeed all the exercises have their answers in the back. The reason I'm sort of waving my hands around here is because I actually do have the paper right here in front of me. There is the answer to Hebrides right there. So there you go. Hebrides really is in the back with a very, very detailed answer in the back. And there's more homework that I want to allocate to you, which you'll see in a moment, because we communicate homework these days by I can see myself going big screen now. That's good. So that obviously did work. There is more homework that I'm going to communicate to you using a slide that I'm going to show you just in a second. I'm going to minimize myself back into the corner and show you a slide. But before I do so, there is something else I want you to get into, and that is the platform. I'm guessing most of you guys are imagining all you have is just me here in the live studio and then this recorded version. And that's it, but it's just not true. You have tons of stuff on your P2 platform. I was there only, when was I there? Just Tuesday afternoon. I was looking in there, just seeing if everything's looking cool. There's loads of stuff. Right down at the bottom is a big grey and red button called Tuition Library. Click into that. You will find that everything is already recorded. Chapter 1, it's all there. Chapter 2, it's all there already. Chapter 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. You can even go to deferred tax. Deferred tax and do it this weekend if you want to. All the everything that you could ever want to know is already there in studio recordings. Recorded like I'm talking to you, you know, straight to camera. So the studio recordings, they're all there covering the entire syllabus. That's all there. There's tons of stuff. It's all related to the class notes, the same class notes The same class notes append themselves to the studio library, so that's a wonderful, wonderful resource. But there's one extra thing that I really want you to have a look at and use, because I don't think it's used enough, and that is if you go into a button called Useful Articles. If you go into a button called Useful Articles, you will see under that button there are 10 multiple choice question bases. There are 100 multiple choice questions, 10 blocks of 10. Multi-choice test 1, multi-choice test 2, 3, 4, 5, 6, 7, 8, 9, 10. And, you know, just download the first one of those and have a go at those. Multi-choice is just a great way of testing if you've got the idea of things, you know, and how they go. Just a really nice resource. I think it's particularly useful if you have a tube journey, a train journey or something like that. It's a way of actively learning in an environment that's otherwise quite difficult. You can't sit down and do a consolidation on the tube, can you? But you can do a multi-choice test. So it's really, I'm very keen, number one, that you make sure you're absolutely cool with all the stuff that we've just done tonight. Number two, get into the library and the platform and get a feel for it. And number three, go and have a look at those multi-choice questions. They're great. But I must admit, there are some slides that are behind me I'm about to make pop up. I'm just going to flick across to them. There we go. So I'm going to minimize myself again, go back down to mini-me. There I go into the corner, like that. And over my left shoulder, at least that's what I imagine, I can't quite see it, but over my left shoulder, you can see what we've just done, which is basic groups. But you can also see on the far left, as you look at it, I imagine. How are you looking at it on the right? On the far right, as you look at it, there's three questions there, aren't there? There's Freddie, there's Hebrides, and there's progress test 1. The progress tests are great. You can do progress test straight away. They're just a single question with a single debriefing video. You can get so much on the platform. Get into the platform, have a look at progress test 1. Freddie is a great question, but as you know from what I was saying earlier, my favourite is Hebrides. And looking forward to next week, as promised. There we go. Oh, hang on. Here's a recap. What should you be able to do now? You should be able to perform simple consolidations. Of course you can. You just do pedal, saddle, handlebar till it becomes easy. You should be able to accommodate goodwill impairment. Yes, you can. You just practice the question, fake and stock and terror. But what are we looking forward to next week? That's the fella. We're going to have a go at complex groups, where we'll be doing complex groups, including, by the way, changes in ownership. We're going to do changes in ownership and complex groups when I see you next week. Till then, have a fabulous week. Thank you for your patience with some of the struggles that we had with the technology between us. Have a fabulous week. Study hard. See you soon.